Hello, everybody. My name is Miles Clark. I'm joined by good friend and colleague Joseph Dazzulo. We are recording this podcast here on Wednesday, so different than normally scheduled program, but Wednesday the 23rd. This might be coming out tomorrow, the 24th, or maybe you're just listening as normal on Friday. Regardless, it's been a pretty good week so far. Now, by the time you're listening, things might have changed, right? So knock on wood. But so far, been a pretty good week. Talk about the Santa Claus rally. There's a new thing, the Easter Bunny rally, right? Did you have a nice Easter?
Yeah, it was good. We spent some time with family and everything, so that was fun. How
I,
about you?
yeah, same. We were driving back up and forth between the office is down in Richmond. We left on Friday afternoon. It wasn't, super trafficy or that's a lie. I was just about to say it was really trafficy. It wasn't super late in the day that we left. We
hmm
left at like 1 or 2 and we didn't get into Northern Virginia until like 6:37.
Yeah,
So
that's 95 in Northern Virginia for
yeah, it
you.
was no fun. But anyways, good time with family and everything like that. And markets seem to appreciate the day off on Friday, coming in on Monday and Tuesday, and now Wednesday, rallying quite a bit.
Yeah. The short weeks are kind of weird for the market. Oftentimes, like it's just something people are like kind of off or
Right.
whatever, and so. And then earlier this week, it's been, I mean, it's a news-driven market right now. There's no
Right.
question about it. But um, you know, things have moved pretty well to the upside over the last 2 days or
Right.
so, and we look like we're getting close to challenging that initial, that 10% rally day that we had, that high
Mhm.
that we put in before we kind of pulled back a little bit. So even though the last 2 days, well, knock on wood, have been pretty good, we're still kind of in this giant choppy range right now after the initial tariff announcement earlier this month. So we get excited for like 2 days, and then the next day we're down 3.5% or whatever. So
Yeah, this is prime FOMO, right?
yeah.
Where you see it.
And the volatility in the market's been pretty wild. Like the VIX has stayed above 30 for the most part over the last month. We've seen it actually kind of drop to new lows today. Um, but I think we're probably going to be in an environment where we see volatility stay elevated for a couple of months at least.
Right.
And we touched on it on Tuesday in our research report, looking at VVIX, which is the volatility of the VIX, the
Right.
volatility of volatility.
Volatility is volatility, right?
Yeah.
Wrap your head around that one.
So it sounds kind of crazy, but the VVIX calculation is the same as what we use to calculate the VIX, except instead of using the S&P 500 options, we're using VIX options to calculate get a reading there. Um, and probably the best definition I've heard of just volatility in general is it's the price of liquidity, right? The bid-ask spreads get wider, the cost of trade becomes higher. If you would really want to move volume, then you're going to have to, the prices are going to have to change quite a bit more.
Hmm.
So volatility is the price of liquidity. And then we kind of expand that and say the volatility of volatility. So that's the volatility of the price of liquidity. Now, VVIX spiked up to around 190 after the initial tariff announcement, where we saw the VIX get up to 60. Now, it's pretty rare that we see that.
Yeah, what I was about to ask, what's the average? I'm not as well versed as you are on this
Yeah,
specific
so
topic.
so the average for the VVIX is somewhere around let me pull it up. But we're actually getting close back to the historical average for
Okay.
VVIX right now, right around 100 or so, between like
Okay.
90 and 100 is kind of
Okay.
like the average. Um, and but the VIX has stayed really elevated, right?
Right.
So the VVIX isn't necessarily telling you where the VIX is. It's just telling you what, kind of the volatility of
Right.
the VIX.
Yep. How it's moving.
And we often see these huge ramp ups in VVIX, and then it just inevitably comes back down. But volatility can stay elevated for quite a while. So, um, kind of on an arbitrary level, but we looked at when the VVIX gets above 150 and then the date when it drops back below. So it dropped back below April 9th. Um, Other prior instances of this were like August of 2024 after the yen carry trade thing
Right.
went down. We saw the VIX get up to like 65 in a day, and then it closed down around like 30 or whatever. Um, Other instances, so January 2022 is an interesting case. Then you have it a bunch in 2020, and you have January 2021 in there, which I kind of consider that COVID period
Right. Still
still.
in there.
Um, And the returns, obviously, in that COVID period moving forward were pretty good for the market. Now, early 2022, that was kind of
Not as good.
not a good signal. Yeah, February 2018, which was like kind of that Volmageddon type of deal, and markets kind of recovered from that. But then later in the year, we saw
Right. Rolled over.
things kind of roll over,
Yeah.
and then we had August of 2015, which was kind of close to the bottom in that type of market environment. But that was a rough year. It was very choppy. Um, but I also wanted to kind of look at, well, what does the VIX do moving forward after that? It on average stays around, on average, it stays above 20 for the next 3 months. The average reading for the VIX over the next 3 months is about 23.
Okay.
So that's kind of why I mentioned earlier. I think we're going to be in a period where we see just heightened volatility. There's going to be a lot of chop back and forth before we actually can establish a good trend, at least an upwards trend in the market. Um, and kind of the way I think about it is like you get this initial shock, right? Which was the tariff announcement. And you get volatility explodes. And then the market kind of digests that initial announcement and then settles into a new kind of period or paradigm for the next several months.
Right.
So we still have the uncertainty from the tariffs. We don't know when the trade deals are going to be negotiated. We've obviously had news sources saying different things and all this kind of deal. Um, the messaging has been pretty inconsistent as well. So we see like, um, oh, we're getting close to a deal with this country, and then we haven't heard anything about it in a week. So
Right.
it's not too surprising to see the VIX still around 30, right? And I
Right.
think we're probably going to be in an environment where we see the VIX between 23 and below mid 30s
So to
for,
decipher everything that you just said,
yeah, it's a
in a
mouthful.
period where a tweet can move markets 3% in a day, you expect to see volatility, right? I mean, is that
Yeah.
the goal? But I mean, this is, the ultimate idea is, hey, we're in a volatile period right now. We expect to continue to see
Mhm.
volatility. And now more than ever, maybe to just bring it back to broad P and F and everything like that, is the importance of having a process, like
Yeah.
you are going to have clients. We know that the phones are ringing off the hook around the Richmond office as people call in. But I'm sure for you listening, your clients are calling you and asking, hey, well, market's down 4% on Monday. Well, it's up 3% on Tuesday and it's down another 2% on Wednesday. What in the world am I doing? How is my portfolio positioned? Should I be putting money to work? Should I not be putting money to work? And so having a process that's built on price alone instead of just actually the headline or the tweet or the emotion that people can see when they're seeing price on the newscast every night is important. That's the big picture, right?
Yeah, and there's like some structural stuff to the market too, and the VIX is kind of elevated. And if we just again define that as the price of liquidity, it's much harder to take on leverage in those instances. So I think as long as we're kind of in this high volatility period, it's going to be really hard for us to reach those highs that we had beforehand,
Right,
where people felt more comfortable taking on leverage, where
right.
they don't feel comfortable doing that now. Um, and then removing ourselves from the tariff stuff. I think there were other things in the market going on that necessarily weren't a good sign. I think we were pretty extended to the upside after like two really strong years in a lot of these areas. We had seen semiconductors, which we had talked about a lot, really cool off in the second half of last
That was the
year.
writing on the wall. They kind of showed some
Yeah,
slowdown before other areas of tech did.
we had seen some things developing even before we got the news type of stuff. Now, I don't think anybody expected us to what happened, with the
Right.
volatility spike and stuff like that. But we did see kind of shifting relative strength, especially in the areas that were the leaders in the prior 2 years or
Which is
whatever.
normal, and
That's
it's
normal.
healthy too. I
Yeah.
want to throw that out there. It's healthy for momentum to see a gradual change in leadership. Now, in the 2020s, things necessarily haven't been so gradual, right? It's
Yeah.
been
One or
pretty
the
pretty
other.
quick.
Yeah.
But it is normal to see that. But and this goes back to something that David and I were talking last week. So if you didn't hear this, maybe just a bit of a recap. But we said, hey, we were pretty washed out after April's decline. What long-term damage has been done to the health of domestic equities. So we expected to see a rebound, which we have seen over the course of the last week or so. The core percentile rank which we won't go into details, but it essentially just ranks where the S&P 500 sits against a bunch of other groups. If that value is high, that means that there's a strong core. If that value is low, it means it's a relatively weak core. We've seen that cross below 90 for the first time, and a 90% that is in the first time in like almost 2 years.
Yeah.
So we are seeing some damage being done to the long-term core. But silver lining on that is that reading, that core reading is still above average,
Yeah.
right? So it's, you do have questions that you're like, well, am I trying to catch a falling knife here, or is it really just, a pullback? It's a difficult question, and I don't have the answers always, right?
Yeah, and I think when we get to these really volatile environments, like it's like the trend charts, they're going to give you, some evidence, right? And then you parlay that with, what our asset allocation tools kind of saying, and then what our
Yeah.
indicators saying. And we talk about the indicators a lot, but they really help um, give us a picture into a market where things seem to be changing every day. Like you said, it's like up 2%, down 2%, up 2% for 2 days, down 3% the next day type of
Yeah.
deal. Um, and on a shorter term basis, like the 10-week for the S&P, that got down to below 10%
That's a
early.
near-term indicator, by the
Yeah,
way. It measures the percentage of S&P 500 stocks trading above their 10-week or 50-day moving average.
yeah,
Presumed.
yeah, exactly. And so one of the days we talked about earlier was January 2022, right?
Right.
And at that point we hadn't gotten to like washed out territory on any of these indicators, right? But that year is a good example of how the indicators can really help guide you, especially if you're looking at something like the 10 week. That got below 10% in June and then got all the way up to over 90% and by August. And then it went down below 10% in September and October, and
Right.
then that was kind of like the low of that period.
Right.
But we did end up getting above 90%, and then we kind of like had another little slight pullback to end the year um, after that market. So you can see these periods where we get this downside exhaustion or washed out territory, and then upside exhaustion as well. So it's important to keep those indicators in mind. And like you guys talked about, the 10-week was so low that like really anything that would push markets higher was really going to push it higher.
Right.
Now, right now, we still see that 10-week still like kind of below 30%, even though it's reversed up. So we have more room for a rally.
Right.
And, looking at charts other than like P&F, if you look at candlestick charts or whatever, there's still a nice little gap from the original tariff announcement right around 5,800. If you look at S&P futures, and maybe a little
Okay.
bit higher, or excuse me, lower on if you just look at spot SPX. So I wouldn't be surprised if we fill that gap. And that kind of lines up with, I think it's going to be hard for us to reach new all-time highs, but that doesn't necessarily mean we're not going to see some pretty significant rallies and then some pretty significant declines as well to go along with it, with what I think is going to probably be a higher volatility environment over the next 3, 6 months or so.
Yeah, it's good perspective. Now, not to just cut us off and switch gears, but do you want to talk just about briefly too, and maybe I'll give you the choice. You want to talk about golden internationals, or do you want to move over to earnings?
I mean, I think gold's pretty interesting too,
Okay.
because that's kind of what we've seen the flight to safety. Now, I'm not sure how much of the buying the last couple week or two has been like a flight to safety type of deal. Maybe people are just caught short or whatever. But
Right.
the whatever it is, the momentum there has been exceptionally strong. I know you're putting together a piece on miners, which have had a fantastic year so far.
Yes, so looking at GDX as a representative for miners now, as through the 22nd, so yesterday, Tuesday, they are up about 48%. Let's just call it 50. That's going to be its second best year in history, dating back to 1993. Sans, was that, but don't have the data in front of me, but 2016, and they were up about 67% through the 22nd. So we've seen extremely strong relative strength from gold, so GLD as a representative, and then the miners, as you would think of as a kind of byproduct of that, are also doing exceptionally well. And so, looking at areas, it's easy. We opened up the call with FOMO. It's easy to say, all right, well, we're missing out on domestic equities. There are areas outside of domestic equities that are flexing their muscles, right?
Mhm.
Gold specifically has been an area in 2025. Also, 2024 was
Yeah,
was
it did
pretty
really
dang good
well.
for gold. Miners as well did relatively well in 2024, if I remember correctly. But yeah, I mean that's the idea there. And then of course, you get a pullback like we have gotten a little bit today as you move a little bit more towards risk on parts of the
Hmm.
market. That gives you a nice buying opportunity for a lot of those, gold focused names. Pullback was long overdue. Now, find relevant support levels, but point being is that if you're looking for a pullback in precious metals, today, as in Wednesday, could be an opportunity for select names, if you will.
Yeah. So gold, it looks like GDX topped out around 53 and it got down to 48 at the low today.
Okay.
And we're recording this around 11 o'clock. So it could change by the time
Right.
this is released, right?
Yeah.
Um, but yeah, gold's been a really interesting story. I've honestly been surprised that it's run as much as it has to the upside. Um, we'll see how long it can keep going at that rate. I don't think the long-term trend's necessarily going to change like right here, but
Right.
in terms of a shorter term basis, we did see a pullback today. We'll see if that has a bit more legs to the downside, but the long-term picture is still fantastic there.
Yeah. No, and then maybe switching gears over into the international space slightly. I just said areas outside the domestic equity space are, still showing strong technical pictures. International is no
Slouch.
yeah, there you go. But yeah, no, we've seen a couple of different relative strength changes in favor of international equities over domestic equities. EFA versus SPX on a 6.5% RS scale reversed back up for the first time since what, 2002.
Yeah.
So we've seen now that's doesn't move around very frequently, obviously, but that happens. You think 2002, right? That's right before the lost, or right at the beginning of the lost decade and the great financial crisis from the domestic side of things. International equities do a little bit better, right? But you do see just a start of shifts towards international equities that we haven't seen in quite a while.
It's
So,
really interesting. And it's really concentrated mostly in developed markets,
right,
which is interesting. People always like to focus on emerging markets because they just move around a little bit more.
right, and China.
But yeah, yeah, and China. But developed markets have done, incredibly well this year, relatively speaking.
Yeah.
So we'll see if that trend continues. And those long-term RS reversals, you don't want to ignore them either. And if we look at other ranking systems like on the asset class group scores, if you look at kind of there are six benchmark groups, um, global and international is now ranked second there.
Right.
Just moved up there to second the other day. So we are seeing this kind of appetite for international, particularly developed equities, hold pretty true for an extended period, relative to what has been like a couple flashes in the pan for a month or two, and then it kind of rolls back over.
Yeah, and I think it's important to mention this, and then we can wrap up. But we're not sitting here and saying it's a complete on and off switch between international equities
Yeah,
and
yeah,
domestic equities, right? It's important to remember that it's we're not saying 100 or zero, right? 0 to 100,
yeah. Mhm.
real quick. But the point is that you can find, you increase your exposure, you decrease your exposure. You don't necessarily have to completely cut ties with domestic equities. You can just slightly add more allocation to international.
Yeah, it could be an area where, where you have some flexibility in your allocations where beforehand, like, why would you be
Right.
in
Stray from the
international
core.
equities
Yeah.
or stray away from like kind of large cap US market? Nowadays, there are areas where you can look towards to kind of either you want to add a diversifier to the portfolio or just find something that's working relatively well at this point.
Yeah, and then speaking about diversifiers in your portfolio and also to your client, right? Well, I won't say gone are the days, right? But like where there is strength outside of the core, you don't have to just go tell your client, well, what are we buying this week, Jimmy? Oh, we're just buying more SPY. Right? Like there is a way
Yeah.
that you can differentiate yourself. And so, I know it can sometimes be a little bit scary when the core isn't necessarily the thing that's just driving forward, but it does give one, you as an advisor, it gives you some leeway with your clients to go out and find those areas that are working. And then two, from a momentum perspective, it gives momentum an ability to go out and find those areas that are working. Now it has to find the right stuff, obviously,
Yeah.
but and that's a whole other story. But it, could not necessarily, it could be a good thing for momentum
Yeah, for
and
sure.
you as well.
I mean, we've been in this core dominated market for years now. There's been some like brief blips, but other than that, like if you went away from the core, you got punished for it.
Right.
Now I think it's a little early to say like
Right. Yes.
that's gone at this point, but we are in a window where um, you can justify getting away from the core a little bit and saying, okay, we're going to test out these other areas. And if they work, that's great. If they don't work, then okay, we'll just go back to the core. And that's, you know, when we get these trend changes or leadership changes, it's never like a comfortable thing to do. But over
Right.
time, you kind of have to take them because the one that you decide not to take is actually the one that works
Right. The
out
one
really
that you
well.
need
Yeah,
just works out that
exactly.
way. Right.
Yeah, yeah.
Cool. Well, let's see. We had plans to touch on a little bit of earnings, but I figure we can just kick that can to next week when everybody is reporting and everything like that because
Yeah, we had some bank earnings this week, but I think what we had Tesla yesterday evening, and then I think we have Alphabet
yeah,
reporting tomorrow. So we still have some of the big tech earnings on
right.
deck, and then of course Nvidia always reports 2 weeks after everybody else
They got to
for
be
whatever
special.
reason. Yeah, they got to be special. Uh, so we'll save that one for next week, I guess.
Yes, sir. Well, listen, pleasure. Our second podcast together.
Mhm.
Here's to many more.
Yep.
Have a good one, everybody, and enjoy the week. We'll see you next time.